Imagine how much money you could make if you knew the most profitable times to buy and sell real estate. In this video, Robert Campbell, America's foremost authority on real estate timing, shares his proven, data-driven method that he's used to predict the highs and lows of real estate cycles since 1975. Armed with this information, you can achieve lasting, long-term prosperity and avoid losing money on the roller coaster ride of real estate investing. Hi, I'm Rob with the Rob Jensen Real Estate Company, and I'm proud to present this video from our exclusive, invite-only real estate seminar featuring Robert Campbell. The seminar lasted over 2 hours, and for your convenience, we chiseled it down to 24 minutes of the most valuable and crucial information, including his 5 key timing indicators. After watching this video, you'll be able to use historically reliable indicators with an 80 to 85% accuracy rate to buy low and sell high. Without further ado, real estate timing expert, Robert Campbell.
What I'm going to talk to you guys tonight about is I'm going to teach you guys how to time the real estate market. Do exactly what I do. Okay, and how to call the top in the Las Vegas housing market. Using the indicators, the 5 key indicators that I'm going to share with you tonight and show you how to use. Here's how well those indicators performed in the Las Vegas market. They told you to sell in 2006, and they told you to buy in 2012. How'd that work out? That work out okay? Exactly. These indicators are accurate 80 to 90% of the time. Sell when home prices are high and everybody's buying. That's when you should sell. Buy when prices are depressed and nobody's buying. Here's most real estate investors. And believe me, I was in this group. Why you should question the buy and hold strategy. I don't think you should buy and hold. I don't think that's the best strategy. I don't think that's the most risk-adverse strategy and best strategy for making money long-term, because does anybody here know where the housing prices are going to be 5 years from now, 10 years from now, 20 years from now? So why would you assume that risk if you didn't have to assume that risk? If you could buy low and sell high. Anybody know anybody here that ever went broke buying low and selling high? Exactly, 0. So you take the path of the best path you can to maximize your return while minimizing your risk. Okay, this is for you old timers out there. Peter Lynch ran the Magellan Fund. 13 years. Mutual fund superstar. His average rate of return over that 13-year period was 29% per year. That's good. Unleveraged. Fidelity Investments was buying and selling this fund over that 13-year period, and their statistics show the average investor that bought and sold that fund lost money. Isn't that interesting? You average 29% per year, and the average guy lost money. You know how that happened? I know exactly how it happened. All of a sudden, they're going here like this. He's doing well. All of a sudden, it shoots up here like this. Do people buy here or they buy here? Here's where they buy. And all of a sudden, go doot, 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 doot. And it goes like this. It starts going down. Then people get discouraged, and they leave. Then it does this. Or that does this. They go, Jesus. And they pull out everything they got, and they go into Magellan, and then it does this. Do they hold through this? Nobody holds through that. You know what's wrong with the buy and hold strategy? One of the things with the buy and hold strategy, you know what they don't put into their model? Is human emotions. When your portfolio's down 50%. I've lived around those people. That their portfolio's been down 50%. I live in a rather affluent area where medical doctors retire and they've got $6,000 and $6 million in their retirement fund. In 2000 and then 2008, 2007, 2008 comes along and it's down to $3 million. Do you think they hold? They don't hold. You know why? What are they in their mind? Where's that fund going? Down. And you know how to stop the pain? I can get rid of the pain for you immediately. Get out. And tomorrow's a different day. And that's what people do. But that's what people do. They tend to buy high, sell low. I mean, that's what they do. And they get out during the painful times. That's why, but what you need is a system for getting in at the bottom and getting out at the top. This guy's all-time superstar, yet the average guy lost money. You go, how the hell can that happen? Because that's what people do. Interesting, unbelievable. Real estate cycles. What happens in the short term is quite different than what happens in the long term. Do real estate prices go up in the long term? Yes. Then how do people are down 30% of their money? Because they don't always go up. People tend to buy here, they sell here. They tend to buy here, they sell here. I mean, look where the volume comes in. Look how many buyers there are here versus here. There's twice as many buyers here as there is here. Just pure statistics, pure numbers. This is life, guys. Las Vegas housing prices. This is Federal Housing Finance Association from 1977 through 2018, compared against U.S. housing prices. So what you have here is, you see here back in the United States here, up until about the year 2000, for this 25-year period here, things were pretty just up and away. Then all of a sudden the U.S. Federal Reserve Board started saying, we're going to make life better for all of you, especially if you're rich. Las Vegas was a town where it was an FHA town. Anybody remember that? Because everything went up about 3 or 4% a year. FHA, no downturns, no upturns. Then all of a sudden the Federal Reserve, then you had this. Then you had this. Now you've had this. Have things changed? Because you know what's going to happen, guys and girls? It's going back to this trend line. I'll just tell you right now, based on reversion to the mean calculations, and this is not a wild guess, Las Vegas housing prices are going to fall 20 to 25% during the next down, if they start falling from right here. But it's not over yet, as I'll show you. Because they're going to return back to this trend line. U.S. housing prices are going to fall about 20 to 25%. So here's what's going to happen. It's going to go back down to, it's going to change. The purpose of investment is twofold: to make capital grow and protect it from loss. Here's what nobody pays any attention to. They become complacent. Vegas, 2003 through 2006. Okay, here we are, coming through here. You know, it went from 200,000 to 375. Vertical move, vertical. Then came down from 370 to 125. You guys have had the biggest recovery of any major city in the United States since the 2012 bottom. And you're still more than 12% back from break even. And this is nominally. Adjust for inflation. You know how much this is inflation? More than 2% a year. Adjust for inflation. And in California, this is everywhere. Investing, you guys, to be successful in life in the markets, you have to adjust to changing market conditions. You have to adjust for inflation, and you have to adjust for taxation. That's hard. That's really hard. But what a goal. What a magnificent goal. What dooms most real estate investors to failure? Housing changes change month by month, but human nature never does. That's your edge. There's your edge. This is what people do. This is where they buy. This is where they sell, because they can't help themselves. That's why you need a system. And I know we're getting to that, but I'll give you a system. I'm going to give you the system. Is real estate the best bet long-term investment? Here was the peak of the market. Here was the peak. They polled people, a Gallup poll or something. They do a poll every 6 months or so, and they poll people and said, what do you think housing prices are going to do in the next 6 to 12 months? Is it a good investment or a bad investment? Well, here's what they came up with. Back in 2006, with the peak of the market, 80% of all people said it was a good investment. And here were home prices. At the bottom of the market in 2012, 65 said it was a good investment, and that was the bottom of the market. In other words, people are exactly wrong almost 100% of the time. That's why you can't ask me. That's why you can't follow the crowd, because the crowd's wrong. They get greedy when they should be fearful, and they get when they're fearful they should be greedy. Your investment plan versus reality. Here's what everybody thinks investing in real estate is like. This is reality. Turn your brain. Look, how will my investments do in 2019? Zoltar knows the answer. Here's how the direction is priced. The 5 indicators I'm going to share with you, you will know the answer. It's not subjective at all. 100% objective. 5 key indicators that can predict market direction. How to buy low and sell high in any real estate market. Follow the key indicators and let them signal when to buy and sell. Indicator number 1, existing home sales. You know what those are. Okay, this is nationally. 9 straight months. Look at all indicators are looked at on a year-over-year basis. Forget monthly data. All that is clickbait. New home building permits down 11% in May, month over month. How about year over year? Oh, they're up 4.5. They just do that because they want to keep you, get you into the article. All year over year stuff. Las Vegas, same indicator. Existing home sales. This is produced by Rob. They're down 9%. This is a market momentum reading. So just call it 9% year over year. Trends wearing out. And here's how things happen. United States, sales are down 10.5%, as I showed you, year over year. Listings are up 11.4%. I was talking to a few of you guys during the break. Remember, there's only one thing that's come out of the field of economics that has any value? The law of supply and demand. Sales are down, supply is up. Is that good for price appreciation or bad? It's bad. Vital sign indicator number 2, new home building permits. Sales are down 9, and I do have it for Vegas. Inventory's way up. It's up 80%. Red flags going up, boys and girls. But don't take any action when the time is set. God forbid do that. Just wait and see what happens until it gets really friggin' bad. Then you could call your broker. How many brokers do we have in here? No real estate agents? Call Rob and go, Rob, it's time to get out. I want you to sell. And he goes, to who? New home building permits, nationally, down a little less than 1% year over year. What are they doing in Vegas? About the same amount. That should be up. If times were good, would home builders be building homes, more homes, or building less homes? More. When they're building less homes, these guys are on the front line. These guys are playing the game. Are they going to keep pulling building permits if they're selling less and less homes? That's why that's a key indicator to follow. Mortgage loan defaults. You know what those are? When you get a mortgage to buy a home and you quit making the payments, the banker files what's called an NOD. Pay up, a-hole. That's what that says right there. See, right there it says, pay up, asshole, or I'm taking your house. Delinquency, we're talking nationally. Delinquency rate for all mortgages in Q3 2018, which is the most current information I have, down 8.4%. So it's still going down. See, during the bust, went up, it's going down, but can you see right now that it's getting slighter and slighter? Indicator number 4, foreclosures. Foreclosure sales, they're down 27.5% in 2017. That's a coincidence. All these other indicators I'm telling you are leading indicators. Leading. They lead the market 3, maybe 4, maybe 5, maybe 6 months. In other words, when you get a signal, you've got 3 months to make a decision. So look at this. But indicator, here's foreclosure said. This came from Rob again. See, we're still down below here. But this is a coincident indicator. So we're still looking good there. Let's look at the 5th indicator is interest rate. This is my least predictive indicator. Housing prices can go up during rising rates, and they can go down during falling rates. But as I explained in my book, you got to use it to your advantage. There's ways of doing that. No change. Okay, this is what's happened. With no change in income, this means that interest rates today, Jan 3, were at 4.55. A year ago, remember we're looking at year-over-year stuff, they're 3.95. So we're up over 0.5%. This means the average person that bought a home with a $300,000 mortgage can buy 7.4% less home today than they could a year ago. Is that good or bad for price appreciation? It's bad. This is the United States. The number of homes on the market is increased by 4.2% while sales are down. That's just a sign that things are getting weaker, not stronger right now. So that means you should be even more observant. Inventory of homes for sale in Las Vegas has doubled in the last 12 months. Inventory of homes for sale in 4 markets. Phoenix is blue. This is year-over-year inventory. Phoenix is blue. We're back to 0. Sacramento's up here, California. California's right on the edge. California, we're, based on what I'm looking at right now, within the next six months, we'll be full on sell. Get out. The city's out right now. We're gone. Get out. Vegas is red. Any of you medical doctors here? Anybody ever see an EKG machine? When that happens, you know what that's telling you? There's a problem. There's a problem. But you're not there yet. We're not there yet. You can't rely on any one indicator. It's one thing to know what to follow. It's also important to know what not to follow, who not to listen to. But this is the Federal Reserve Board, Ben Bernanke. This is Las Vegas housing prices. No housing bubble to go best. This was October 2005. Strong fundamental support, relatively soft landing in housing. Ben Bernanke, March 2006. U.S. housing market is cooling off, but it's orderly. May 2006. Orderly decline. Ooh, yes. Tale of two California cities. Price index, California, Bakersfield. This goes back to 1977, just like the charts I've been showing you for Las Vegas. San Diego, peaked in 1990, got back to break even 1998. Took 8 years to get back to break even. 8 years. You had to wait. During those 8 years, you were recovering from losses. 2005 to 2017, it took 11 years. Actually, it almost took 12 years to get back to break even. But forget San Diego. That's typical of California. Let's look at Bakersfield. Anybody ever heard of Bakersfield? Yeah. Right. 8 years back, the same thing. From 1992 through 2000, 8 years to get back to break even. 2006 through 2017, 11 years later, we're still 28% below break even. We all knew that was coming though, right? You knew that was coming, right? And so we knew not to invest in what? Bakersfield. Unbelievable. San Francisco and San Bernardino. San Francisco. So it peaked in 2006. 8.5 years later, we broke even. 2017, we're up 35%. Bakersfield's down 28. So we all knew, though, to invest in San Francisco, not Bakersfield, right? Of course. Right. That's common knowledge. You knew that was going to happen. Just contact Zoltar. San Bernardino, Riverside. 10 years to get back to break even. Peak in 2006, we're still 18% below break even. San Bernardino. So these aren't super rare black swan occurrences, guys. You guys won't get back to break even. You won't get back to break even before the next downturn starts. That's my prediction. I mean, I'll track the market, but you won't get back. So anybody that was holding through the peak, now they're waiting to get back to break even because they don't want to lose money. Now 6 years later, they're going to be down more, 40%. Look, if you have $10 million and you lose 50% of it, I'm not going to cry any tears. But you might, because it feels like crap losing money. But so look at this. So San Diego, 11 years later, you're 18% break even on a purchasing money down point. So if you're saying, okay, I'm going to retire at age 65 in 2015, and I need this money, I'm going to sell here and need this money, I need all this money, you're short 18%. I mean, that's not too bad. But let's look at Bakersfield. You're short 41%. You're pretty well screwed. You're pretty well screwed. After Bakersfield did this, or Las Vegas did that? Does anybody look at history books and see what it's done in the past? Why wouldn't you sell? What, because it's going to double again? It's going to 600%? You can't believe how many people I talk to. I said, sell. Get out. Oh, we think it's going higher. Yeah, we'd have to pay a high tax. Well, guess what? 11 years later, 6 years later, 7 years later, they didn't have a tax problem anymore. That tax problem solved. Self-fulfilling. So congratulations. You don't have a tax problem. Boy, do homeless people have tax problems? Las Vegas, let's adjust Las Vegas housing prices for inflation. Let's just look at that. Oh, this works real well as a long-term investment. Oh, yeah. And here's what's going to happen. See, this is the long-term trend line. Now, this is rather subjective how I drew that in, but not that subjective. Can you see where things kind of that kind of follows the trend? Then it did this. Then it came back this to below the trend line. Then it's coming back here. Here's what it's going to do. It's going to go back there. That's what it's going to do. Money illusion. This is, since 1965, this is what's happened to wages nominally. They've increased 651%. Back inflation out, they're up 21%. That's purchasing power. That's why the average American has gone so deeply in debt to maintain a standard of living. Math of losing money. You guys lost 70% of your money during the downturn. To get back to break even, you have to make 233%. Is it easy to make 233% on your money? Not in the world that I'm living in. Don't lose money. Why have housing prices gone up this time? Because when the Fed dropped the rates to near zero, everybody's looking to get a return on their money. When rates are at zero, you know what year CDs paid? 0.5%. So that means you made if you had $1 million capital in the bank, which most people don't have $1 million. Most people have most people don't even have $400, let alone $1 million. So you have $1 million, you're going to make $700 a month. That sucks, because that took a lot. You had to do some right things to make that. So what are people doing? They're getting into real estate. They're into the stock market, right? They're into the stock market. They're into real estate, chasing yields to get some kind of yield. We're in the second biggest housing boom of all time. This is the Case-Shiller. This is Robert Shiller's index here. Boom. These are adjusted for inflation. This was a boom. 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 You know what's interesting? I'll share with you guys a secret. The distance here between this boom here and here to get back to break even was something like 6 years. This was like 8 years. This was like 11 years. This was like 12 years. See, I'm a pattern guy. Could it be different this time? Yes. Could Bill Belichick get in the Super Bowl next year and lose? Yes. Is that the way you want to bet? You know what the next downturn is going to be? I think there's a good chance. It's going to take 15 years to get back to break even. Based on historical patterns. Why does that happen? I don't know. Don't ask me why, ask me what. Interesting, huh? I just noticed that a couple months ago. I go, these cycles are getting longer and longer. You think the last down cycle took a long time to get back to break even? Just wait. With mortgage rates rising, can home prices keep rising at 6% if wages are only rising at half of that? No. Look what happened here. This is U.S. home prices. This is hourly earnings. Came way above the mean, crashed down below the mean. Way above the mean, it's going to come way back down. That's what's going to happen. I've seen that happen over and over again. Look at this. There's no better teacher in history than history in determining the future. Charlie Munger, my boy. This here's the rate of inflation, Consumer Price Index. This is the Case-Shiller National Home Price Index. From 1955, notice how it tracked almost, there was a few bumps up and down with the price of inflation, right? It goes up 1% a year more than inflation. I told you that. Now all of a sudden it went way, way above the rate of inflation. Did it stay there? No, it came crashing down. Look where we are today. If that chart doesn't keep you guys up at night, I don't know what will. Net worth is as a percentage of disposable personal income. Asset bubbles, the last two. Here's the dot-com bubble. This is U.S. net worth. Went up here, crashed down here. Housing bubble, went up here, crashed down here. Housing and stock market bubble. You think it's just going to keep going like this? Or it's going to come back down here like this? You want to understand what's going to happen in the future? Study the past. This is the past. Is it perfect? No. Does it give you a good idea of what people acts do? Yeah. Right here, do you think people are greedy or fearful? Greedy. Are they greedy or fearful? Fearful. Greedy or fearful? Greedy. Fearful or greedy? Fearful. Exactly. Human nature, there's your edge. I gave you guys the edge. That's the biggest edge you will ever have, human nature, because it's totally predictable. Human nature will never change in a million years.